Hello everyone, welcome to my YouTube channel. In today's video, we are going to learn about one of the most important topics in accounting, the cash flow statement. I will explain everything in simple words, so by the end of this video, you will understand it fully. Let's get started. So first of all, what is a cash flow statement? In a simple words, it shows how cash comes in and cash goes out of a business during a specific time. It helps us to understand if the company actually has money in hand to run its daily work or it's just a profit on a paper. Now let's see the definition. A cash flow statement is a financial document that records the inflow and outflow of cash and cash equivalents within a specific period of time. It mainly answers three questions. Is the business generating enough cash to sustain operations? Can it pay its bills and debts on time? Or where is the cash coming from and where is it going? So it's like checking how well a business is managing its money. You might already know there are three main financial statements: the balance sheet, profit and loss account, and the cash flow statement. I have added statement of changes in equity also. So, if the company has any change in equity, they need to prepare the statement of changes in equity. The profit and loss accounts shows how much profit the company made, but the cash flow statement shows the actual cash movement, the real money going in and out. This helps us to know the company's real financial health. In a cash flow statement, we include cash and cash equivalents. Cash simply means money in hand or money kept in the bank. Cash equivalents are a short-term investment that can be easily changed into cash. For example, T-bills or we can say treasury bills, fixed deposits or short-term bank deposits, money market funds, commercial papers. So basically, cash plus cash equivalents is equal to money that's quickly available in the business. Now you might be thinking, does every company have to prepare a cash flow statement? The answer is no. Some companies are exempted, meaning they don't need to prepare it. So the following companies are exempted from preparing cash flow statement. First is one person company. This means a company with just one owner. Second is small company. These are private companies with a small size where the paid up capital is up to rupees 4 crore and turnover is up to rupees 40 crore only. And third one is dormant company. These are companies that are registered but not active right now, may be kept for a future project. So only large and active companies are required to make a cash flow statement. Now let's understand the purpose. Why do we even prepare a cash flow statement? The main purpose is to know how much cash a business earns and spends in a period. We can understand cash generation, evaluate the quality of earning, it is based for a future financial planning and cash budgeting. We can ensure the dividend and debt repayment decisions. It is also helpful for the stakeholders to take decision. We can detect cash flow problem early so we can protect our company from the future circumstances. Let's make it easy. The cash flow statement has three main parts: operating activities, investing activities, and financing activities. Operating means cash from daily work of the business like sales, salaries, and expenses. Investing activities, cash used to buy or sell assets like land, machinery, or investment. And in financial activity, cash raised or repaid through shares, loans, or dividends. Operating means day-to-day work. Investing means growth in assets, and financing means funds and capital. Now, how do we prepare a cash flow statement? There are two methods. First is direct method. We list all cash receipts and all cash payments directly like a cash book. And second is indirect cash flow statement method. We start from the net profit and adjust it for non-cash items like depreciation or changes in working capital. Most of companies use indirect method. In India, we are using indirect method only because it is simpler and based on accounting data. Cash inflows from operating activities. This is the cash coming into the business. Cash received from customer, cash received from commission, royalty, fees, etc., refund of tax, cash received from insurance claims, if any. Now comes cash outflow, the money going out of the business. Payment to suppliers, we are paying salaries and wages, normal operating expenses, for example, rent paid, electricity bill paid, income tax paid. These are cash outflow. Cash comes in when the company sell its assets and goes out when it buys new assets. So cash inflow in the investing activities are sale of property, plant and equipment, machineries or land, building, etc., sale of investments, and we are receiving interest or dividend if it is investing activity. Cash outflow, it means money going out of the business. We are purchasing of property, plant and equipment, machineries, etc., purchase of investment, lending money to someone. So it is the another example of cash outflow from investing. What is the financing activities? Cash comes in when the company issues shares or take a loan, and goes out when it repays loans or pays dividend. So these are activity for the business growth. And how it is financed, it means procurement of a fund. So cash inflow in a financial activities are issuing shares, borrowing, issuing debentures. So we are getting a cash from these activities. Now comes cash outflow again, going out of the business. Cash is going out of the business. We are repaying loans, we are paying dividend, buyback of shares. So these are the another example of financing activities. And that's all for today's video. I hope this simple explanation helped you to understand the cash flow statement, its meaning, purpose and activities. If you found this video helpful, please like, share and subscribe to my channel for more commerce related videos. Thank you so much for watching. See you in the next video.